Hi, so I'm going to speak today about taxing capital gains from abroad, from assets that are from abroad, and taxing capital gains from foreign securities. Now, there's a great difference between holding a security, which is a foreign security, and having a different asset abroad as real estate or, I don't know, a machine or something like that. There's a real big difference in the calculation of taxes. So I want to take you to some quotations from the tax ordinance. So this is, as known, Chelik Hey, Part E, actually, of the tax ordinance, which has definitions of what is a capital gain, and also the taxation rates and offsetting these losses. So the paragraph in the law that refers to the taxation of capital gains is paragraph 91. And I just want to mention it because there's some more details, but in general, it says as follows. An individual shall be liable for tax on real capital gain, as stated in section 121. This section is your personal tax rates, okay? At a rate not exceeding 25%, and will see capital gain as a higher stage of his taxable income scale. And then it refers to substantial shareholders that they would be taxed on 30%, more or less, because the other details I haven't quoted, but more or less a person that is under the age of 60 will pay 25% on his capital gain. If it's over 60, it will be according to section 121, which is the personal tax rate, and the maximum tax will be 25%. So we just referred here to the term real capital gain. So section 88 deals with the definitions of capital gain, and it says as follows: capital gain, the amount at which the consideration exceeds the original price balance. But a real capital gain, a capital gain minus the inflationary amount. So it's very intuitive for everyone what inflation is. I mean, it's the consumer price index, it's the rise of the value of the money. But here there's a catch, because usually it will be the linkage to the CPI. You have to neutralize it and pay taxes on the real capital gain. But as is quoted here, okay, I'll just take it a bit backwards. Per seen as a measure. Okay, the foreign currency or its value is linked to foreign currency. The currency rate will be seen as a measure, but it says here about security. Per the property. Oh, well, it's not a full translation. I'll just go to the Israeli version. Okay. So in the Israeli version, it says what is the index? That's the consumer price index. But for the security, I did an automatic translation. For security, that a person, okay, a single person, okay, not a company or anything, a security. Now the linkage, let's put it in here so it will be blunt. The foreign currency or its value is linked to foreign currency. So if you're a person holds a security, okay, shares of a foreign company, or I don't know, shares or other that are linked to a foreign currency, in this case, the foreign currency will be our measure, our index. So we'll have to neutralize the foreign currency differences when we do a calculation for a security, for capital gain from security. Okay, so I just want to show you what happens when we do a calculation for an ordinary asset, not a security. So there's a circular from the 2004 which speaks how should you translate foreign currency into Israeli shekels. And up to around 2003, you actually had, it was a different tax system where income from abroad wasn't taxed in Israel. You were only taxed on territorial basis. And in 2003, this concept changed, and an Israeli resident needed to report and be taxed on his income all over the world on a personal basis. So the income tax took out circular like this that refer to all kinds of different income and how you would translate it. So they speak about capital gains, okay, not security, ordinary capital gains. And they say to you, you know, on your purchase day, you take that currency exchange rate, and on your sale date, you take that currency exchange rate. You do not, if you have if the revenues and expenses are generated after translating new shekels into offsetting losses, they will be transferred to the coming years in new shekels. Once you've done that, it becomes to stays in shekels. So I just want to show you. I'll start from the normal, all the assets, not a security, how the calculation is done of a capital gain. So we have the details here, the date of a sale and the date of purchase, and actually just our total cost and our net return after expenses. We put the exchange rate here, and we got to the sum in Israeli shekels. Now, as you can see, we actually have a capital loss in, you know, nominal value in our own hands. We have a capital loss. This is actually the real exchange rates at the time at 21 and 15. As you can see, the pound really was pounded hard, and it's around 30% decrease in the value of the pound. So we have a loss, and I didn't go to the just a moment. Okay, this is the ordinary. Sorry, these are the ordinary capital gains. So we have it's the same details more or less up to now here. So we have a capital loss, and the inflation rate, I mean the CPI, is around 4%. We actually don't. We just use these currencies, these exchange rates, to translate our sums. So we have a capital loss. We are neutralizing the linkage differences, which are about 4%. So from this loss, we have 17, which are actually increased or because of the inflation. We don't really, you know, if you neutralize it, you actually grow your loss, which you don't do according to the income tax. So you have a loss here, and this loss in tax terms is a tax asset. You multiply it by 25%, and you have a tax asset. If you have any income from abroad in the same year, you can offset this loss, and it is worth 17,000 shekels. If you don't have an asset this year, you will if you don't have a profit from abroad, you can bring it to Israel and use this amount to offset a loss against a capital loss. Okay, it's loss against a capital loss. So this is the normal, I mean, for every other instrument or asset that is not a security. But what we actually see is people don't hold a lot of, I mean, if people hold the real estate also abroad, they don't hold so many assets like that. And you actually see more calculations of securities, which, you know, today it's a digital asset. It's very easy to move, buy and sell. It's very, so we don't see a lot of these where you just take the inflation, the real inflation, rather than taking this CPI amount, you use the currency. So that's what we're going to do. You can see here, instead of using the 4%, we're using the currency as the index. It's the same data. So we have the capital loss as before, but at this stage, we're neutralizing the linkage differences. And in this case, it's the 27%. Okay, as you can see, you take the cost and you multiply it by the currency depreciation, and you actually end up with a real capital gain, which you have to pay taxes on. So this is a very strange situation where you actually lost, but you have to pay taxes. I'll just show you the formula. Okay, so here we divide our, take our sale exchange rate and reduce the purchase exchange rate and divide it by the purchase exchange rate. And then we get to a decrease of 27%. Okay, so this is a strange situation. This happens when we have, where it can happen that we actually pay taxes, and rather than having a tax asset, it usually happens where the currency against the shekel goes down. I mean, for many people, it's the usual thing that happens every year, but it's not. I mean, it can happen in a different way. These are, I'm sorry, I haven't translated it, but we can see, for instance, if we just moved okay, you could see that this is the cost and this is the return. We transformed them where the cost is less than the revenue. So we end up with a capital gain of 40,000. So when we have, this is, if you put the linkage here, so we take our sale, because we changed it, just made it upside down. As we can see here, we have a 27% here. Okay, I didn't take the inflation here, but more or less, you know, it's nothing, the inflation. So you take the 40% and you multiply it by the tax percentage. So here we neutralize it. Okay, you can see we've done it. And we have around 15,000 currency differences, which we have to neutralize them. And look, they are in a plus because it's as if the currency increased in value. So we neutralize them and we end up with a sum that it neutralizes 40,000 less 15,000. And only this is taxable. So in this case, when we have increase in the currency differences, we actually win against the taxes. This is about capital gains. It's very similar in the concept to a deposit that you have in Israel that is linked to the currency differences. You can actually lose because of the currency differences and find yourself paying taxes. In this regards, there actually are a lot of court rules regarding that, because it's more common for, as I said, having a capital sale is not a common thing, while having a deposit in the bank is more common, having interest. So it's the same idea, more or less. I'll just show you the, well, it's in Hebrew, but it's I'll just cover it very shortly. It refers to paragraph 1 of the tax ordinance, where it says that currency difference will also be considered as an index, very similar to the chapter E in the ordinance. You should take it as an index, and they actually give you exempt from these currency differences. Also in the capital gain part, they give you an exempt. That's why, you know, you have to neutralize them because they're exempt. See, that's the only thing I've written. I'll just, okay, but also the inflation, these inflation income, inflation profits, I think it's 93. Yeah, 93. Up to 93, the inflation profits were taxed in 10%. And after 93, they're completely exempt. And the rationale behind neutralizing these linkage differences, at least, you know, regarding the inflation, is not, I mean, people could find themselves, if people know that what happened in Israel in the 80s, there was a real hyperinflation, which meant that people had to pay a lot of taxes, and it's on, you know, profit. So then they differentiated both. And actually foreign currencies were, I mean, you know, the inflation doesn't rise by itself. If a country goes into hyperinflation, the country's currency will also decrease against other currencies. That's the meaning also of inflation. So that's more or less the logic. But as you can see, it just brings you in, you know, today's terms into a funny situation where in one calculation, when it's not a security, you're not holding shares, you didn't sell shares, you end up with a tax asset. And if you are, because you have to pay taxes, you actually lost, but you have to pay taxes. I mean, for many years, Israel is, the shekel is just roaring forward, and this situation is very common today. So thanks a lot. Thanks for watching, and you're invited to press the like button.